Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Welcome to our weekly podcast. Global equities trended lower after multi-weeks of gains amid a risk-off sentiment triggered by Fitch Ratings' downgrade of United States long-term foreign currency issuer rating, while bond yields edged higher after the US government announced that it will boost its weekly bond sales by more than expected. For the week, the MSCI World, MSCI ACX Japan and MSCI China indices fell around 2 to 2.6%. In the US, the S&P 500 index, Dow Jones Industrial Average and the Nasdaq Composite fell around 1 to 2%. Back home, Indian equities trended lower for the second consecutive week. The Nifty index remained under pressure for most of the week amid weak global sentiments, mixed earnings reporting, and foreign investor outflows to post a weekly decline of 0.7%. Broader markets continued to outperform Nifty this week, with the Nifty Mid-Cap Index up 0.7% and the Nifty Small Cap Index up 0.8% for the week. Sectoral performance was weak, with the IT and Pharma the only sectors to end the week in green with gains of over 1.9%, while Realty was the worst performing sector with a cut of around 4.2% for the week. The Indian fixed income market remained under pressure for another week, with bond yields rising across the curve, driven by a surge in US bond yields after Fitch Ratings downgraded United States long-term foreign currency issuer rating to AA+ from AAA, and the US government announced raising the weekly bond sales by more than expected. For the week, the 10-year Indian government bond yield rose 4 basis points to end at 7.19%, while the 3-year and 5-year Indian government bond yields rose by 7 basis points and 4 basis points respectively. The INR had one of its worst weeks in the recent times, depreciating 0.7% against the USD to close at 82.8 per dollar, coming under pressure due to rising crude oil prices, stronger US dollar, higher US bond yields, and foreign investor outflows. Among the macro updates for the week, the first was on India's manufacturing PMI, which eased to 57.7 in July compared to 57.8 in the month of June, but came above market consensus of 57. Output continued to expand, but at the softest pace in the last 3 months, while new orders picked up at the fastest pace since November of 2022. The pace of job creation was in line with what we've observed in the month of May and June, and outstanding business went up for the 19th consecutive month. On prices, input cost inflation hit a 9-month peak, while selling pressures were higher, but the rate of inflation eased to a 3-month low. Overall, sentiments continued to remain strong on hopes that demand will remain elevated. The second update was on India's services PMI, which rose sharply to 62.3 in July of 2023, higher than the last month's reading of 58.5 and the broader market consensus. Services PMI was boosted by rises in new orders, mainly in international sales, as new export business grew the most since September of 2014. Meanwhile, employment increased slightly, with the rate of job creation at the same pace as in the prior 2 months. On the pricing front, input cost inflation accelerated to a 13-month high due to higher food, labor, and transportation costs. Meanwhile, output cost inflation eased to the softest in 3 months amid efforts aimed at preventing any negative impact on new business. Lastly, business sentiment weakened from June's 6-month high amid concerns about extreme weather. Overall, composite PMI rose to a new peak of 61.9 in July 2023 from 59.4 in the previous month. The last update was on India's fiscal deficit. For the period of April to June of fiscal year 2024, India's fiscal deficit widened to INR 4.5 trillion or 25.1% of the budgeted estimates. This reading was higher than the deficit of 21.2% recorded in the same period last year. Total receipts stood at INR 6 trillion or 22.1% of the budgeted estimates, while total expenditure stood at 10.5 trillion or 23.3% of budgeted estimates. That's it in this edition of the podcast. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.